Hey guys, a very warm welcome back. So what I think is very underrated as traders is that a lot of people focus on making more winning trades. You see that everywhere in the marketing. You see that all in your face all the time. Make more winning trades, make more winning trades, make more winning trades. And that's fine. However, what I think is a very powerful tool is to focus on making fewer losing trades. Sounds great, doesn't it? But if you think about it, if you could reduce your losing trades by 10, 20, even 30% over the year, how would that improve your bottom line? Regardless of whether you're a new trader and you're yet to make money, or you're a seasoned trader and you're making good money, or you're a seasoned trader and you're going through a losing patch, or anywhere in between, imagine how that would affect your bottom line, being able to reduce your losing trades. So this is kind of what I want to focus on now, and it's not a sexy thing to focus on by any means. It's not like this is an amazing strategy and setup that's going to make you money, but it will make you money in the long term. And at the end of the day, that's what we're about. Whether we're day trading, swing trading, investing, whatever we're doing in the markets, all we want and all I care about at the end of the day is my bottom line. How I get there, it doesn't matter. So if I can reduce my losing trades and I can make more money at the end of the year, bonus. So let's talk about some of the strategies that I use and I know that other traders use as well. So the first thing to look at is, let's say you're day trading, and I'm a day trader far more actively than I'm a swing trader, but this works both for swing trading as well. You can just use the same strategies on the time frame that you're using. So what I will look for is I will look to see what the range is in the day. So for example, if I've been trading actively Dow, or I've been trading crude oil or DAX or one of those kind of things, I am going to look and say, on an intraday basis, where do I want to get involved? So what I will do is I will put on average true range, and I will put it on a 1 period. So that's going to give me literally the range of the bar, including a gap as well. The average true range, don't forget the true range includes the gap if that's greater. So it's not quite the range of the bar, but it gives you a very good approximation. I put it on a 1 period and I use a histogram type display. Just personal preference, but something like that. Just a way of filtering out when the market is active. And then I can look at it and say, listen, this Dow is so quiet today. In 15 minutes, the average kind of candle we've got on here, or the average bar, or the histogram length is 15 points. 15 points in 15 minutes on the Dow. That's nowhere near good enough. That's not going to cut it for me. I need to see more than that. I might even drill down and go to a 1 minute and say, well, I'm on a scalper. I want to get involved. What's the kind of the average we've got here? And I'm seeing very, very few over 10 points. So 10 tick range is considered extreme for this particular day I'm looking at. So for me, it's not worth getting involved. I don't want to get involved because I know I'm far more efficient, far more effective trading when we've got much bigger ranges. So then I'll scroll across, and let's see if we can find a day where we had a decent range and actually would have wanted to get involved, and I can tell you actually if I've been involved in it or not. So for example, what have we got here? This isn't too bad, is it? 1 minute, we've got a 1 minute here. The explosion around 8:30. In fact, let's go to something so it's in normal trading hours, because that's when we'll be trading, is the 2:30 till 9 o'clock period if we're trading the Dow. Otherwise, if we want to trade earlier, we're more than likely going to be trading on the DAX. Now this is a bit better, right? It's not as good, it's not perfect, but it's a bit better, right? We can see now we've seen a little bit higher. 8, yeah, it's not really great. I don't think I would have got involved in that. Let's find a really good one that just stands out and we just say, yeah, you know what, that's exactly what we want to trade in. Here's a good example. I think in the afternoon here we're regularly putting in 10 tick ranges. We're putting in some 20s, and that kind of makes it more tradable. It's not a perfect example. I'm not cherry picking. I'm just going back through the days. So one thing I would do is I would say, listen, have we got a decent range? If we've got a decent range and a decent volatility coming in, because range obviously is volatility, then I can pick out some strategies. I can look at my strategy playbook. I can then look at where we are and perhaps get involved. So going back to the point of filtering the trades, how does that affect my trading from a perspective of not making losing trades? Well, do you know what? It stops me getting involved in just choppy nonsense. Look at this here, right? Absolute awful environment from a scalping trading perspective, and you're in it there for a good hour. And the range, we barely even went over 5 ticks for most of the time. If I can just see that line there I've put on that. 5 ticks for an hour on each 1 minute candle. Okay, there are some people out there who will trade that and have a strategy for that. Not me. I need to see some volatility. I need to see at least some excursions away, some stretch, some mispricing that I can get involved in, some momentum I can get involved in, whether I'm looking to fade it or join it, whatever it may be. So range is a really good tool. And let's have a look at a daily chart and have a look at it from that perspective. So let's say we had a basket of stocks. And we had a basket of stocks that we got in our database that we knew we liked to trade. Let's say they had Apple, Facebook, Amazon, Netflix, Google, all those kind of stocks. And we just wanted to know when to get involved. Same kind of thing. We could look at the daily range of the bars and see how they were relative to prior months or prior weeks, whatever. So let's look at Facebook, for example. FB, we can say, look, really active at the end of the year. Now it's not too bad. We've got a reasonable range. That's quite a steady, nice stock to get involved in. Regularly good ranges, little spikes taking it to about $4 range on the day. But the average is not too bad. There's a couple of dollar average range on that. It's pretty tradable. Let's have a look at something else like Netflix. I spelled that wrong, didn't I? It's Netflix, not Netflix. And you can see here, little spikes of volume, but then it tails off. So I can also look at it from a pattern perspective and say, okay, well actually we get a big spike in days range, and I'll trade it when it's really active in the day. But then the next day, it kind of sometimes drops off, so maybe I'll back off the throttle a little bit on that. Let's look at something like Disney. Disney, very, very active coming up to earnings, and then it's just gone quiet again. So, broadly speaking, I can look at the range of what I'm doing, and I can see what I'm thinking about trading, and I can kind of look at it and say, what, is it worth me tuning into it today? Is it worth me accessing from a swing trading perspective? Is it worth me in putting some effort into getting involved in it? Crude oil, again, went through a phase where it was really, really quiet. This period here, very, very quiet. Then it picked up again. Range started to get active. Range started to get involved. So you could set some alerts. You could just go through your scans and have an idea before the week starts what you want to trade, what you want to get involved in. And that stops you getting involved in choppy markets. Because without going into too much depth about supply demand, at the end of the day, if supply demand is balanced, and I don't know if you can see this on the webcam, but so let me draw it for you. If you've got supply demand that's in balance, that's supposed to be the pivot point right there, and you get a slight little adjustment, so you get slight bit of move, you're going to get the market moving in one direction because you've got a slight imbalance. But all it's going to take for it to move or to stop is a slight move in the other direction, or for it to continue another bit more in that direction. So if that makes sense, it's basically saying that it doesn't take much for it to move. If you've got huge supply demand in one direction, so massive bit of supply coming in, hammering the market to the downside, big ranges in volume, good pushes lower, then you're going to have to see good movements in that supply for it to change direction. Either that's got to back off, or big fresh demand's got to start coming in. So it becomes easier to read from a trader's perspective. Whereas if it's just chopping around back and forth, you could probably move the market yourself if you're throwing several contracts at something that's thin in the middle of no man's land, and that's no use. That's no use, especially if you're trading some bigger stuff. So one way of doing it, filter things out by their range, whether it's on a small time frame chart or a higher time frame chart.